Your beverages, adding taste to healthy. In the previous report, we looked at revitalizing your beverages, exploring options for expanding, including financial opportunities to cover the additional expenses related to the new adventure, examining the possibility of consolidating existing loans to extend the repayment and period to secure a lower interest rate. This strategy would free up capital for the business daily operations, which are essential for continued success. Maintaining sufficient capital is crucial as it serves as the company's lifeblood. Additionally, the decision to finance the new product line would provide the company with an additional revenue stream and help refinance current liabilities. The weighted average cost of capital is a key financial metric to evaluate investment and financing strategies. It calculates the average cost of capital from debt and equity, influencing business valuations and capital budgeting. A higher WACC indicates increased risk and higher financing costs, important for investors assessing potential investment. The WACC serves as a discount rate for calculating the net present value of future cash flows, which affects the shareholders' value. When a company returns exceed its WACC, it creates value for shareholders, while a lower WACC typically results in a higher net present value, enhancing investment profitability. To lower WACC by reducing debt costs, decreasing equity costs, and restructuring capital, this can impact decisions on whether to distribute earnings to shareholders or retain them for future projects. For instance, if interest rates on bonds are lower than the expected return on stock, issuing bonds may become more attractive. Therefore, WACC is a crucial factor in corporate valuation, informing loan applications and operational assessment. Options trading involves understanding moneyness, which categorizes options as in the money, at the money, or out the money, based on the option strike price compared to the underlying stock price. A call option is in the money when the stock price is higher than the strike price, meaning it is intrinsic value. It is out the money when the stock price is lower than the strike price, and at the money when the stock price is nearly equal to the strike price. Understanding these categories helps in evaluating the value and performance of options. To find the intrinsic value of an option, subtract the strike price from the current stock price. Any premium above this intrinsic value is called extrinsic value. Traders pay this premium based on factors like implied volatility and time decay. At expiration, option lose extrinsic value. Only intrinsic value remains. Knowing these concepts is critical to making intelligent choices in option trading. The call option lets you buy a specific asset at a set price by a certain date. The cost of buying a call option is called the premium, which can impact potential profit. Call options can help you manage risk since they require less upfront cash, but they can also increase the risk because many options expire worthless. Sensitivity analysis is a technique for examining how changes in independent variables affect dependent variables. It plays a crucial role in finance, helping professionals analyze various scenarios and their potential impacts on financial models. For instance, consider a company evaluating a new product line. A sensitivity analyst might alter key variables, such as production cost, sales volume, and market price. If the analyst reveals that a 10% increase in production costs leads to a 20% decrease in profits, the company can swiftly recognize the risks involved and reconsider its pricing strategy, cost management. This kind of analyst allows leaders to foresee possible outcomes and gauge the vitality of their decisions. In financial modeling, sensitivity analysts serve to predict results and highlight the importance of strategic choices. Ultimately, it enables executives to make informed decisions more confidently, understanding the risks and challenges tied to their commitments. Whether launching a new product, entering a market, or investing in technology, this informed approach can significantly mitigate risks associated with poor decision making. Debt and equity are two primary ways for companies to raise money. Debt include short-term borrowings and long-term loans and parts of leases, while equity consists of common and preferred stock, along with retained earnings. Capital structure refers to the mix of debt and equity used to fund operations and growth, shown on the balance sheet. Investors analyze capital structures for investment potentials. Business financing is crucial for starting, running, or expanding a company. Effective cash flows management help avoid financial challenges, and understanding tax obligation is essential for financial stability. Business is often used a mixing of financing sources like loans, investors, grants, and co-founding. Equity financing. This method raises capital by selling ownership shares, allowing growth without debt, and removing repayment burdens. However, it can dilute ownership and require sharing control with investors who may seek exits that pressure the business. A solid business plan is vital for attracting equity financing. Debt financing. This involves borrowing from banks or lenders, which can be secured or unsecured. It allows owners to retain control, but requires regular payments that can impact cash flow. Understanding loan terms is essential for aligning your business goals. Ultimately, balancing both debt and equity financing can be beneficial in both based on the company's needs. Evaluating risk factors associated with short-term and long-term financing options is crucial for sound financial decision-making. Short-term financing typically has a more straightforward application process, allowing quicker approval. However, the ease of access often comes at a cost. Short-term loans usually have higher interest rates, which can escalate the overall borrowing cost. Additionally, these loans often come with stricter repayment terms, which can pressure borrowers, especially those with variable cash flows, to meet obligations due to shorter repayment periods. In contrast, long-term financing generally involves more significant loan amounts and offer lower, more stable interest rates, which aids in budgeting and financial planning. Despite these benefits, long-term loans have significant risks. Projects that require long-term borrowing without immediate returns can strain cash flow and limit the borrower's capacity to unexpected challenges. Furthermore, long-term financing often lacks flexibility, binding borrowers to extend your repayment schedules. Nonetheless, the potential lower monthly repayments make it appealing. For Yelp, seeking long-term financial could strategically support a new initiative focused on expanding production capacity. This approach would provide the necessary capital for the business, reduce current payments, and allow for a greater focus on other areas. Additionally, this initiative could facilitate potential mergers with like-minded companies, creating further revenue opportunities. In this option, if this option is viable, it would also help save an extra production cost related to expansion. Ethical considerations are crucial for achieving environmental, social, and governance goals. They influence the value and practices of organizations focused on making sustainable impact. And to make good ethical choices, businesses must examine how their actions affect stakeholders such as employees, customers, suppliers, and communities. Organizations that share their ESG performance and progress culture create a culture of trust and strong leadership. It is important to involve stakeholders in ESG initiatives and address their concerns. In the beverage industry, key focus areas include environmental, social, and governance. To tackle these issues, organisations must work with stakeholders, plan strategically, and commit to ongoing improvements. Proposal evaluates the strengths and weaknesses of your beverages financial options. A WACC of 3.48% is favourable for financing as it reflects lower capital cost, enhances investment opportunities, suggests reduced risks, and offers financial flexibility. The call option price of $11.70 represents a solid investment opportunity for the potential for high returns at limited risk. It allows capital leveraging and strategic investments with a lower initial outlay. Sensitivity analysis is vital for risk management and strategic planning. It aids in financial forecasting, investment appraisal, and stakeholders' communications by clarifying how variable input changes the impact overall performance. Capital structure balances risks and returns, optimizing financial performance and supporting long-term growth. Long-term loans are suited for large investments, while short-term loans effectively address immediate cash flow needs. Finally, ESG standard improvements social and environment outcomes, potentially boosting financial performance and competitiveness. The focus should be on expansion or debt consolidation.